30 minutes until the opening bell. I'm Lisa Abramowicz. Let's take a quick look at the markets. A constructive tone ahead of the 10 a.m. Fed Chair Jay Powell's speech. We do have yields a bit lower, actually falling a little bit more on the 10-year as the session grows older. A bit of dollar weakness against some of the peers. Euro at 1.1757. S&P futures up 0.3%. Oil getting a lift after capping probably its best week going back to October. From New York, this is Bloomberg.
What I'd like to see out of Jackson Hole is for the central bankers to say, this is an emergency policy response.
The sense of their long-term views on employment, I think, is arguably the most important thing to focus on.
My own thinking is that tapering is not going to start in this meeting.
Powell is going to try not to make big waves.
The earlier the Fed tapers and the more aggressive they are in tapering, 10-year Treasury yields probably will not rise that much.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A most interesting Bloomberg Surveillance today as we are 1 hour away from a widely anticipated speech by the chairman of the Federal Reserve System. Here's what we're going to do for you on radio and TV, and please stay with us through the entire hour because we've lined up wonderful conversation here. Michael McKee will drive forward our conversation with Harker, Kaplan, and Bullard before we get to Powell. And Lisa, all of this wrapped around the ambiguity, the mystery of market reaction.
The mystery of market reaction and, frankly, the mystery of the path of taper, right? The idea here that they're going to pull back their $120 billion of monthly bond purchases, this they've telegraphed very well. We don't know when they will start. We don't know how quickly it'll go, Tom.
Well, we don't know how quickly it will go. There's a partition of taper. There's a partition over to rate dynamics. I thought Kit Jukes this morning, Lisa, really quite good on that. I mean, the basic idea here of when we raise rates, it's out there in the distance, isn't it?
Yeah, I think that Raphael Bostic put it very well. He was saying that he looks at those two instruments of the Fed's completely differently, that basically buying bonds at a certain pace is not necessarily the same kind of tightening or loosening as the rate hike that some people are expecting out in 2023. How much, though, are they going to communicate that they are going to wait much longer to raise rates following the initiation of the taper?
What I love about this, folks, is everybody has a different path to their economic excellence. And Michael McKee, I don't think I've ever said this, to see someone of interesting business academics and then took the toughest job in the country. No, not the chairman of the Fed, the president of the University of Delaware. That's a tough job.
That was a tough job, and Pat Harker just totally bailed on that to go be the president.
Rescue me.
President of the Philadelphia Fed, and he joins us now. Thank you very much for joining us, Pat. And as I mentioned to Raphael earlier, we are a lot warmer here in the studio, and I'm sure you are in Philadelphia than we would be on the back lawn at Jackson Lake Lodge, where it was 37 degrees a short time ago. I'm wondering about heat in terms of inflation. We got inflation numbers today. The headline PCE goes up to 4.2%, faster than you had anticipated and higher than had been anticipated by the Fed. Does that suggest to you that we might need to see, and I know taper comes first, but that we might need to see interest rates rise sooner than the market has been expecting?
First, good morning. Yeah, we're a little warmer, although I do miss the view. The view from my office my home office is a lot different. And go Fighting Blue Hens, go University of Delaware. So on inflation, I mean, clearly it is a concern. The word transitory, I think, has been used probably in some ways too much. But there are clearly sectors of the economy which are accelerating faster than others. That's always the case. The question in my mind to watch on inflation is, are we seeing spillover from these COVID-infected sectors to the non-COVID-infected sectors? And are expectations becoming unanchored? So far on the latter point, the answer is no, but it is clearly something we need to watch. And what we're hearing from our business contacts is that this may be longer lasting than we had expected, they had expected. So it is clearly a risk that we have to be cognizant of with respect to policy.
Are those people telling you that they are going to have to keep raising prices in order to make up their margins?
What I hear from our contacts, business contacts, is they're working very hard not to raise prices. They are seeing some increase in productivity. The good news is we are seeing across the economy and in individual sectors increases in productivity, which helps mitigate some of the challenges they're facing. But it doesn't completely get rid of them. So yeah, they're concerned about this right now. I think generally they're very concerned. One major national home builder I was talking to recently said, these supply chain disruptions we thought were temporary don't look as temporary as we thought. They will eventually solve themselves, like appliances. But right now, they're putting in used appliances into new homes and promising to deliver a new appliance because they simply can't get the appliances. In that case, because of chips, to a large extent. We think about cars and chips. Well, they're chips in your dishwasher.
And sometimes they don't work in my dishwasher. If the rest of the Open Market Committee follows your advice and decides to start tapering fairly soon, what kind of message does that send at a time when people are very unsure about the impact of COVID on the economy?
Yeah. So Delta is clearly a problem. And the next one, it's not just going to be Delta. First and foremost, we've got to get this pandemic under control. And the way to do that is get people vaccinated. This started with a health crisis. It's going to end by solving the health crisis, not by raising rates or lowering rates. So we need to keep that first and foremost, right in front of our mind. And we need to tell everybody this. So, yeah, I mean, given that this is a health crisis, I think we need to follow, as our colleagues, and Raphael was just on, have said, we really need to follow the data and see how things turn out over the next couple of months. We put these systems in place, we put this accommodation in place because of a health crisis. And we will be able to remove it now because we are slowly, carefully chipping away at the health crisis, but we're not there yet.
We talked a lot about inflation this morning, but what about the labor market? Committee in its minutes of the last meeting suggested you'd made progress, but not nearly enough. And even if we get a similar jobs report next Friday to what we had, you're still going to be about 6 million short. I'm wondering if you expect to make up that difference very quickly, or if the participation rate is going to stay low, and that might change your thought about the proper path for policy.
So separate two things there. It's a good question. One is the path of policy, but also what is causing this? What's causing this? It's not a lack of demand. It's clearly not a lack of demand. We see that in the JOLTS data. Lots of open jobs. People are still concerned about coming back to work. People are concerned about getting on transit, say in a city like Philadelphia, to get to the workplace. People are concerned about going to the restaurant with the Delta variant, et cetera, et cetera. And so again, until we solve those problems and childcare and all the other things holding people back from entering the workforce, that's going to be an issue. Unemployment insurance is rolling off. I mean, the expanded unemployment insurance. We are starting to see some of those early results from some states that removed the federal unemployment early. Yeah, it doesn't seem like that's having a huge impact on getting more people into the labor force. It's these other factors, life. I put it as simply as life, right? Taking care of kids, taking care of elderly parents, getting to and from work that's causing this. So what does that mean for policy? If what I just said is true, then adding accommodation or keeping a highly accommodative policy is not going to solve that problem. It's not going to close that gap. It's not a demand problem. It's a supply problem.
Well, within that, and Patrick Harker, I think you're best situated of anybody within the Fed. I note that the Philadelphia Fed, with 4 or 5% of the American population sitting on 1% of the land, it's a microcosm of this nation, the manufacturing index back in 1968. Great. What do you hear from the small, the mid, and the large business people of your district?
So they're nervous. I mean, I think generally people are nervous and about what the future holds. But that said, they are seeing lots of demand. I I mean, our manufacturing contacts, our manufacturing business outlook survey, although it's ticked down a little bit in terms of future activity, it's still an expansionary territory. Their biggest problem, and you know this, is getting skilled labor. And by the way, we should put this in context in some of the work we're doing in the Philly Fed. This problem of skilled labor and labor generally was with us before the pandemic hit. The pandemic has just exacerbated the problem. It hasn't created the problem. We still need long-term structural solutions to solving our labor woes. And that's the kind of work we're doing in our community development function at the Philly Fed and really across the Federal Reserve System.
Well, at the Philly Fed, you said something that I think is just fascinating, Patrick, that some of the supply side issues that we're seeing in the labor market, the frictions there, are not solved by monetary policy. This isn't something that holding rates low for a longer period of time or even buying $120 billion of bonds every month is going to solve in its own right. So how do you determine the potential negative ramifications from the ongoing $120 billion of purchases with the lack of influence, frankly, on solving these labor market dynamics?
So I have been on record, and I continue to be on record, that I would like to start the tapering sooner rather than later. I'd like to start it sooner rather than later, and I'd like to keep it as simple as possible. The old engineer in me, I'm trained as an engineer, the old KISS principle, keep it simple, stupid. Let's just start this process, let's get that over with, and then we can start to think about the Fed funds rate and normalizing the Fed funds rate. We're not there yet. I'm still forecasting late 22, probably 23, before we do liftoff. But let's get the tapering process underway.
Mike, let's engineer this Jackson Hole right now. Is this a Jackson Hole of complexity or simplicity, as the president speaks of?
Well, that depends on whether you're reading the papers, which are complex, or whether you are talking about raising interest rates or starting to taper. I'm wondering, Pat, if you think that starting to taper is going to have an impact this soon on the whole Fed, the new framework, the idea that you're waiting. Will people take that the wrong way and think that you're giving up too soon?
No, they might, but I don't think that's appropriate. We have achieved our inflation goal essentially. I mean, we're above 2%. Again, good news is expectations have not become unanchored, but we are averaging above 2%. And keeping this accommodation through tapering there for a long period of time, when it's not solving the labor problem, that's not the problem. Just look at how many jobs are open in the U.S. economy, the JOLTS data. I just think it's the prudent thing to do, to just take this first move, and then let's see how things play out before we think about any change in the Fed funds rate.
We talked about whether or not the Fed has contributed to inflation by propping up asset prices. A lot of people have said fiscal policy is contributing to inflation by putting a lot of money into the economy. And now down in Washington, they're debating hundreds of billions more. Are you worried that leaving aside the political merits of this, are you worried it could be inflationary?
Well, let's start with what we know almost exists. It's not done yet, but the infrastructure bill. As an old civil engineer, I'm all for fixing our infrastructure. It's in woeful shape across our economy. We need to fix it. So what's the implication? What impact will that have on the economy? Well, I mean, the evidence I've seen, at least the modeling I've seen, is that $1 trillion will have maybe 1.2% impact on GDP. So we're not talking about a huge overall impact. In certain sectors, absolutely, but not overall. My biggest concern right now is not that it's going to overstimulate, that bill itself is going to overstimulate the economy. It's that where are we going to get the labor, the skilled labor, to fix the roads, to do the broadband work, and so forth. That we need a really intensive effort to get people into the labor force with those skills. Now, the broader issue of the $3.5 trillion, that is, right now, I don't have a fixed opinion on that because really that's a moving target every single day, and it's very hard to model such a moving target.
All right, very quickly, Pat. Next Thursday, September 2nd, Delaware Blue Hens versus the Black Bears of Maine. Winner?
Oh.
Well, I'm always going to go with the Blue Hens. Come on.
I set you up for that.
Everyone will be fully vaccinated. Patrick Harker, thank you so much. Greatly appreciate it this morning. The voice of Philadelphia. And this is wonderful, folks, because it's a changeable feast of what the Fed invented, the geography of the nation. And Michael McKee, it's pretty simple to say the culture, the fabric of Philadelphia, radically different than what Kaplan holds court in Dallas.
Yes, certainly the culture is a little bit different. Robert Kaplan, much more likely to be wearing cowboy boots than Pat Harker. Robert Kaplan is the president of the Dallas Federal Reserve. And this is, I guess, Rob, a little bit like we're all sitting around the table at the Fed meeting, the Open Market Committee meeting, because each one of you is getting in turn your chance to describe the economy. Let's ask you, in Dallas, in your region, what are CEOs and company officials saying about whether this inflationary spike that we've seen is going to continue because maybe COVID is going to disrupt supply lines even longer?
What they're saying is the material supply-demand balances are going to last longer than people may be expecting. Now, certain material imbalances are going to get resolved, but semiconductors, my contacts are telling me it could take much longer to see those imbalances resolved. One of the reasons is a lot of the changes we're making to the economy, electrification of the auto grid, for example, takes a lot of semiconductors. And so we're going to produce more semiconductors, but demand is growing. So that's the materials. The one that I think is going to be even more persistent is the labor supply-demand imbalances, in that we've had 3 million retirements since February 2020. We have 1.25 million people who've left the workforce to be caregivers. You have a fear of infection. And broadly, businesses are becoming resolved to the idea it's going to be hard to attract labor. They're going to pay more. The wage increases are certainly for labor welcome. But I think businesses are actively thinking about how to manage their business. And if they're a big business, they're going to use more technology, more scale. Small, mid-sized businesses, the only option they have is to raise prices. And they're doing that, and they're more confident that they can raise prices and have them stick.
Well, I'm sure you probably heard Pat Harker just a moment ago talking about if we get this stimulus bill, the infrastructure bill, we could see inflationary impacts because there aren't enough workers. How much do you worry that inflation is going to be embedded in these companies' thoughts going forward because they can't find workers?
I think these labor supply demand imbalances will be with us for an extended period. So do I worry about it? I think it's going to be part of our economy, a feature of our economy. And I think that as a result of that, our year end at the Dallas Fed, our year end PCE inflation forecast is 3.8, 3.9%. I could see it firming to even to 4% by the end of the year. We think the extreme moves will moderate, like used car prices. Some of those extreme moves from the reopening will moderate, but we think price pressures will broaden because of some of these persistent imbalances, particularly on labor. So headline for next year, we think right now is in the range of 2.5%, and I could see us, revising that up versus down as we go through the next few months. So I'm watching it carefully, and we've got a commitment at the Fed to anchoring average inflation at 2%. We're willing to run moderately above, but we've also got a commitment to anchor it. And low, moderate income communities, I'm talking to actively, are seeing a greater share of their wallet going to gasoline, food, rents, autos. And they're feeling those effects.
Well, I know you're a 2022 guy for raising interest rates, and you also want to get the taper over with. Is it possible that we see the Fed have to move up the date of liftoff for the Fed funds rate?
I've been very careful to emphasize that decisions on the asset purchases should be separated from decisions on the Fed funds rate. We've got a number of months and into next year to assess how the economy unfolds, how these dynamics unfold. We'll make that judgment next year. I do believe we should start the asset purchases adjustment process soon. I mean, literally as soon as possible. And I would like to see us do that process gradually over, say, 8 months. And I think we've got to get started on that. And I think to the extent we get moving on that, it may actually give us more flexibility down the road on our decisions on the Fed funds rate.
If you're just joining us, Robert Kaplan of the Dallas Fed with us on radio and television worldwide as we celebrate what we do at Bloomberg and all of Bloomberg surveillance is economics. Michael McKee leading our coverage in this hour as we go to the speech of the chairman of the Federal Reserve System, and we show you worldwide the geography of this nation from Philadelphia to Kaplan's Dallas and on to Bullard's St. Louis as well. Robert Kaplan, good morning to you. You know I bust your chops about Dallas research because you're the only Fed president that actually reads his research. You have a spectacular research piece linking surging home prices into rent inflation. And buried in Jim Dolmas's piece is 6.9% rent increases in 2023. Is your Fed ready for that?
I think low, moderate income communities are not ready for that, and they're very cognizant of having to deal with it. And I think what we're saying, part of our 2.5% plus forecast for next year is we need to anticipate this appreciation in home prices is going to translate into higher rents down the road, and that's got to be part of our thinking.
It's been highly publicized, Rob, that Fed Chair Jay Powell seems to be a little bit more dovish or a little bit more patient when it comes to the taper, when it comes to the rate hiking cycle. Where do you guys disagree most? I mean, where do you see him wrong in his thinking in terms of being patient at a time of rents going up that quickly?
Well, I actually reframe what you asked slightly. I think the role of the chair is to encourage a process of debate and disagreement. This is why I thought it was so important to get asset purchases on the table. But his job is I believe the chair's job is to encourage debate and disagreement, try to forge a consensus, and understand views in order to come up with policy and have a good process. And I think Jay Powell does a superb job at that.
Are you expecting him to make any kind of announcement today in terms of taper timing?
I would not go near commenting on what Jay Powell's going to say in his speech. I don't think it'd be appropriate.
You are tough. Kaplan doesn't expect that from you.
You had to try, right?
That was brutal. Bad
form. I'm not going anywhere near there. Yeah.
All right. Would you expect that the Open Market Committee on September 22nd would announce a beginning of taper, or that it would come at the next couple of meetings?
So right now, I'll speak to my own process, and that may reflect on what others are doing. When I've been talking pre-resurgence, I thought we ought to be moving soon on asset purchases and beginning that process. With the resurgence, we've gone back at the Dallas Fed and redoubled our efforts over the last X number of weeks and intensively over the last 10 days even, to look at high-frequency data, real-time surveys, stepping up, talking to contacts. And what I'm seeing and what I think we're going to see up until the meeting, but I'm going to keep reconfirming this, is resiliency. That doesn't mean that you won't see some slowing in, say, the August jobs numbers because the matching process will slow because of fear of infection. It won't be because of lack of demand for jobs. You might see a little near-term slowing in GDP, but I don't think what we're seeing is going to change the outlook. And that's the process I'm going through leading up to the meeting. And I would guess others are doing the same process.
Robert Kaplan, thank you so much. Greatly, greatly appreciate it this morning with the Dallas Fed as well. Lisa Abramowicz and Tom Keene keeping up with Michael McKee in this really special hour of Jackson Hole because it's nice and warm and cozy in here. And we'd be up to 42 degrees right now, right?
Yeah, possibly.
Out in Wyoming. What'd you learn there from Harker, from Kaplan, which changes what you'll ask Bullard in the next 30 minutes?
Well, I don't know if it'll change what I asked Jim Bullard, but I think what we're hearing is we've gone now beyond the Fed Bank president saying it's time to taper to we're keeping an eye on inflation, and this all plays into the question of when we can tighten. Not that they're predicting tightening, but they want taper out of the way.
Lisa emails in from the Upper West Side and says, Tom, ask Mike what taper actually means. What does it mean for the people listening and watching? What's the so what of taper?
Well, the Fed buys roughly $120 billion worth of bonds each month.
They take in the bonds.
$80 billion worth of treasuries.
And somebody's clipping the coupons in the vault, right?
And actually they do. They get the coupon payments, and that all goes to the U.S. government in terms of remittance from the Federal Reserve. They buy about $40 billion in mortgages, although the mortgages depends on how fast the prepayments are going. And they will just cut back. They will buy less. The general consensus is maybe cut $15 billion a month, which would mean an 8-month taper. It, in theory, doesn't raise interest rates because it's still stimulating the economy, just stimulating it a little less.
Michael McKee, thank you. And we'll continue here with the gentleman of the regime change, Mr. Bullard, James Bullard of the St. Louis Fed. He's been very, very visible in his comments, always to the point. The gentleman from Indiana University, that's a college a little bit south of Purdue, I believe, on the Indiana map. James Bullard to join us. Lisa Abramowicz and Tom Keene with futures up 10, Dow futures up 66. Lisa just emailed me, says, Tom, look at the 10-year. 134.41 on the 10-year yield. We look forward to the chairman of the Federal Reserve, but first, Bullard and Mike Wilson of Morgan Stanley. This is Bloomberg. Stay with us.
Let's take a quick look at the markets right now. We are seeing a lift, although retracing a little bit of earlier gains. S&P futures up 0.2%, 44.76. The Russell 2000 up also 0.2%. Meanwhile, if you flip up the board, take a look at the dollar index. You actually saw a big lift up, strengthening versus peers as some of these Fed officials speak. Taper very much on the table. From New York, this is Bloomberg.
At the top of the hour, the chairman of the Federal Reserve System hugely anticipated a speech for 2021, a speech for 2022. Stay with us.
It started with a health crisis. It's going to end by solving the health crisis, not by raising rates or lowering rates. So we need to keep that first and foremost, right in front of our mind. If we put this accommodation in place because of the health crisis, and we will be able to remove it now because we are slowly, carefully chipping away at the health crisis, but we're not there yet.
Mr. Harker of Philadelphia with comments this morning as we have a wonderful morning of economics. For those of you that are market participants, Michael Wilson will join us from Morgan Stanley. We need to take a break from the economics at one point. Lisa Abramowicz, I'm channeling my inner Jonathan Farrow. The markets are open.
Yes, the markets are open. It's unusual to hear you channel your Jonathan Farrow. Interesting to see some of the increases kind of come off a little bit at the open. Crude still maintaining its lift, posting I believe to be will be the biggest weekly gain going back to October. I will say it is interesting, though, to note the market reaction or lack thereof as some of these Fed officials talk. The message seems clear, at least from the ones we've heard from so far. And that is, Tom, taper very much on the table, taper very much just a matter of when, not if.
And we'll talk about that with James Bullard here in a minute. We need to look across the markets, and we do that with Kriti Gupta right now. Kriti, what do you have?
Well, Tom, obviously we're seeing stock market open just a little bit higher. A lot of anticipation baked into the market of Jackson Hole. I don't need to tell you this. We've been covering it all day. Yields hovering about around 134, but you're also seeing a positive reaction in crude futures right now. That seems to be where all the cross-asset action seems to be. And, of course, VIX futures, or I should say the VIX, hovering as well. Really crucial to talk about some of those individual movers, though, because Peloton is really at the top of the list. Those laundry list of concerns missing their fiscal 2022 forecast, announcing a price cut to their most popular bike by $400, and pointing out a problem with their with their accounting as well. You also have HP revenues falling thanks to that chip shortage, also downgraded at Morgan Stanley. And lastly, I do want to mention those oil markets. Once again, you can see crude futures on your screen right now up 2%. This has everything to do with that Ida storm bearing down on the Gulf, potentially cutting some output, potentially getting some of those platforms evacuated.
It'll be interesting to see, of course, all the commodity complex, including natural gas, as well. We have spoken with Harker of Philadelphia. It is rather different in Dallas. And then there's the absolute unique characteristics of St. Louis Fed. If you think of modern economic research, guess what? St. Louis invented it years ago. And they have, Mike, the chart service they have. The fax service they have.
Everybody loves Fred.
The only one I know that can actually use the thing, it's so wonderfully complicated, is James Bullard.
I was using Fraser the other day, which comes from Minnesota, which, all this historical stuff. Jim Bullard is the president of the Federal Reserve Bank of St. Louis, and I guess we could ask, have you ever seen anything like this before in the economy? But I kind of know the answer, Jim. This is a unique experience. You were among the first to say that the Fed should start tapering, and I'm wondering if that's because you are afraid of inflation hanging around and may need to raise rates sooner than the markets anticipate.
Yeah, I think we do Fraser as well in St. Louis, so just to set the record straight on that one.
Oops.
I think the key word is optionality for 2022. We want to, or I would like to anyway, taper now and get it finished by the end of the first quarter. And then at that point, I think we could assess what's happening in the economy with respect to inflation. By that time, we'll have many more jobs reports, and it certainly looks like they'll all be strong to varying degrees. Unemployment will tick down with a 4 handle at that point. And then we'll be able to see in the first half of 2022 if inflation is moderating or not. And if it's moderating, then we're in great shape. And if it's not moderating, then we might have to be more aggressive. So I think that optionality has a lot of value right now. I think the purchases don't have much value right now. So it seems like the trade-off is just right to me. Let's phase out the purchases and let's give ourselves some breathing room in 2022.
Well, as you look over the forecast horizon, do you think that inflation sticks around?
Yeah, I think right now, sitting here today, I'd say 2.5% or higher in 2022 on core PCE inflation. So we're all, right now we're at 3.5 on core PCE inflation. That's the committee's preferred smooth measure of inflation, the one that's enshrined in the SEP, the Summary of Economic Projections. So it looks like we're going to have quite a bit of inflation this year. That 3.5% number measured from 1 year ago is higher than it's been in 30 years and is enough to bring the average inflation rate, however you want to calculate it, on that measure over any 5-year period, either looking back or looking forward, up to 2%. So then in 2022, the question is how fast is inflation going to moderate? If it moderates quickly, then we're fine. But if it doesn't moderate and I'm right and we're 2.5% or higher, then the Fed might have to start to try to put downward pressure on inflation in order to keep it at the right level.
Do you worry that interrupts the new framework, the idea that you could have to raise rates because inflation is higher than you anticipated, but you don't get the unemployment rate down as far as you would like to, or at least in terms of the diverse and inclusive unemployment rates?
Now we'd be hitting the new framework exactly. Beautiful monetary policy under what I'm describing, because we would have at that point had inflation above the 2% target for some time. And then inflation on a core PCE basis would be averaging 2% over some kind of 5-year window, either backward-looking or centered and forward-looking. And so you'd be hitting it on that dimension. And then I think on the jobs, you've got to think about not exactly where we are today, but where we're going to be at the end of the taper. The key thing here is, when is the taper going to end? And it certainly looks like you're going to have a very strong jobs market at that point. I mean, you can make the argument today that this is one of the tightest job markets we've seen in recent decades, because the unemployment to vacancies ratio has gone down below 1, so more than one job opening for every unemployed worker. If you want a broad measure of labor market performance, you can look at the Kansas City Fed's labor market conditions index. That's moved up into positive territory and is headed toward very high numbers, which will be, again, indicating one of the strongest job markets that we've seen in recent decades. So I think, all of that corroborates what you're hearing on this show and everywhere across the economy about jobs, which is that firms are having a really tough time hiring. They're offering wage increases, they're offering bonuses, they're offering signing bonuses, retention bonuses. They have job fairs where no one shows up. So lots of things seem to be pointing to a very strong jobs market right now. And if you're going to have 6% growth in the U.S. economy over the second half of this year and 4% growth next year, that's just going to improve all that much more. So I think we'll be in great shape in the first half of 2022, but we have to have some optionality there in case inflation doesn't moderate.
Well, what are companies telling you about what they're having to pay and how long they think they're going to have to pay it, both for input goods and for labor? Is this going to be something that at this point they're anticipating a bit of a cycle?
Well, one of my top concerns, and I've heard it on listening to you guys, is CEOs will come in and they'll say, yeah, my input costs are way up, but we don't think this is a problem. We're going to pass that right on and raise prices. And, my labor costs are up, but we're going to pass that on into prices. That sounds like a worrisome dynamic to me, and one that, we certainly want real wages to go up, but for everyone, we want those to be as high as possible. But we don't want to get into a cycle where that just feeds through to the inflation process in the economy.
Jim Bullard, Tom Keene, good morning to you. Thrilled to speak to you before Chairman Powell. Jim Bullard, I want to go back 5 years to two big things of 2016. One of them was Marvin Goodfriend and the uproar over his paper at Jackson Hole, the late Marvin Goodfriend, folks of Carnegie Mellon, on zero interest and the negative rates. Well, guess what, Jim Bullard? Goodfriend was right. Negative rates up worldwide as well. And also, you may recall in 2016, somebody in St. Louis said, forget about a single point outcome. We are going to have the different states of a regime change. Dovetail what happened 5 years ago and take us out 10 years. Can we get to a constructive different state given the huge negative interest rates worldwide?
Yeah, I think after Professor Goodfriend's paper, central banks around the world did experiment with negative rates, I think with very mixed success. And I think that's why we've tried to avoid that outcome in the U.S. With respect to the regime, I mean, I did switch in 2016 to saying that I thought we were just in a low inflation, low nominal interest rate, low real interest rate environment, slow growth, and that wasn't going to change very readily. And that meant that monetary policy didn't have to be as aggressive as we had previously been. So I was kind of on the dovish side at that point. But now we're coming through this pandemic, and policy-wise, it's been a human tragedy, of course, of unimaginable dimensions. But from the economy's point of view, we've played it very well as a nation with the fiscal policy and the monetary policy. And now we're coming out of the pandemic with a very strong economy. And I think it's very possible that we're switching into a high productivity growth regime. And that means somewhat higher interest rates than you'd otherwise have seen. It means faster growth than you otherwise would have seen. And I'm hopeful that all of that occurs. The last time we had a faster growth, higher productivity growth economy was the late 1990s, where we boomed for 4 years and started talking about paying off the entire national debt.
Well, and Jim, you're talking about negative.
That didn't happen.
Yeah, that didn't happen. No.
That didn't happen in the end.
But Jim, you're talking about negative interest rates and how that's been problematic in certain ways, and certainly in the United States it wouldn't be as smooth as it has been in other places for the money market fund and a variety of other reasons. But you've talked about the need to get interest rates up so that we can use that and combat the next downturn, have some ammunition. If we cannot get rates substantially higher, how do you foresee asset purchases factoring into future stimulus?
Yeah, they've become a standard part of the toolkit, and we used it after the global financial crisis, pioneered by former Chairman Bernanke, and kudos to him for that. And then, when this crisis came along, we went right back to it with considerable success, I would say, in the March-April 2020 period, where we really were staring at a possible depression and a possible financial crisis. And I thought Chair Powell did an excellent job during that time frame in getting us into a policy that avoided the financial crisis that could have occurred on top of the pandemic, and put us on very good footing. It wasn't too long after March, April that financial stress measures came way down from very high levels, and we got back to normality, at least with respect to financial markets. So asset purchases are part of the toolkit, and they're here to stay. But right now, I don't think they're helping us that much, and they may be causing harm, especially in housing, where we don't want to feed into an incipient housing bubble. We got into a lot of trouble in the mid-2000s with housing, and I'm not too anxious to try to see that happen again. So I think that just the time has come to end these purchases and get the committee and the nation some optionality for what we may have to do in 2022, but we're certainly going to keep sharp control over our interest rate decisions. We're not going to be on any kind of mechanical path, but we're going to want to assess where we are in the spring of 2022 to see what course we want to chart to keep inflation under control from that point forward.
Jim, let me ask you one last question, and that's about how you think the Wall Street folks are going to react to this. There's been a feeling that you guys are propping up the big gains that we've seen in the indexes, and the fact that the bond market has kept rates so low indicates they believe that we're not going to have an inflation problem. If you send a message that maybe we will and it's time to stop giving you guys support, are we going to have a problem?
I don't think so. I mean, you talk to pretty much everybody in the markets, and my sense is that, at some level, the tapering process has already been priced in, maybe not all the details around it or exactly how it will unfold. And so there's a little bit more there, but certainly seems like commentators and traders are well aware that there will be a tapering process, and that it makes sense at this point, given how well the economy has done. This economy is producing more national income than the one that existed before the pandemic. The pre-pandemic economy didn't have zero interest rates, by the way. So I think markets would react. In some broad sense, they'd react well to this, because it would mean that the Fed is going to stay in good position to handle all the possibilities that might come. If inflation moderates in 2022, we're in great position for that. And if we get the taper out of the way, then we'll also be in good position in 2022 if we have to tamp down a little bit on inflation pressure in the economy.
Dr. Bullard, thank you so much for joining us today from St. Louis. Jim Bullard as well. Michael McKee, this has been extraordinary, almost as good as a chairman's speech here in 14 minutes. Bostic, Harker, Kaplan, Bullard, what's the one thing you learned?
We had
Quick
our own
observation.
FOMC meeting.
We
here.
did we get a vote?
Well, they didn't.
Who
really,
dissented?
They didn't really need to vote. And I don't think there's any dissenters. I think what you're seeing basically is the committee coming together. They may differ on whether the taper should start in October or November or December, but they're basically all at that point. It's time.
If this was Wyoming, folks, McKee would go off to the Pioneer Grill right now. I think he's going over to McDonald's on 3rd Avenue instead, which is not quite the same thing. We will continue with Michael McKee with the important headlines at 10 a.m. Lisa Abramowicz and Tom Keene in New York in a virtual Jackson Hole. We welcome all of you on radio and television worldwide. We said, okay, economics. You know what? It is about the Dow Jones Industrial Average. Michael Wilson joins us right now. Mike Wilson with Morgan Stanley, their chief U.S. equity strategist. Mike Wilson, thank you so much. Within your note on the markets, and I'm going to call it a Morgan Stanley caution on the markets, is your careful study of inventories. It's boring. Why do inventories matter right now for Mike Wilson and for Chairman Powell?
Yeah, I mean, inventories is definitely part of the story for this year. I think there's two ways to look at inventories, Tom. I mean, clearly we do have a supply issue. I mean, I think everybody on your show this morning has gone over that point that demand is strong, supply is short, which is why we are seeing inflation in a lot of different items. The question is it going to be transitory or not? That's the big question. The other side of the sort of coin, the way we think about it is we don't think inventories are actually that low. If you actually look at where inventories are today, ex autos, you actually see inventories above the long-term trend. And so what we think is going on is pretty simple. We had an exogenous shock to demand, both on the downside and then the upside. We're now above trend. And so demand is overstated. And that's making people think inventories are too low. When demand normalizes, which is what we think it will do, that's not a recession, by the way, it's just a normalization of where demand is going to be longer term, the inventories will all of a sudden appear.
Right.
And I think you have a very good example of that already in the housing market, Tom. You've seen, obviously lumber prices rocketed up.
Yep.
Then, of course, you've got inventory, appeared magically. And then, lumber prices adjusted sharply lower. And I think we're going to see that in some other areas. One area, we've recently downgraded DRAM stocks, in semiconductors. Everybody's talking about supply shortages. And, well, that's an area we think where pricing is going to be weak because supply is actually going to be pretty good ultimately.
Mike Wilson, you have the advantage of Morgan Stanley fixed income, the dynamics of it all. The fact is there is a wall of unimaginable liquidity. When the facts change, how will our liquidity change?
I think, you spent a lot of time this morning talking to all the Fed governors, and we're going to hear from Chair Powell shortly. The economy is very different from the markets, as you know. And, we clearly have had a robust recovery. It's been spectacular. We've also had a robust policy support. And that policy support is about to become less robust. And that will have probably a bigger impact on financial markets than it will have on the economy. I don't think there's any doubt that we should be tapering at some point soon. I mean, the economy does not need emergency monetary policy. I think the governors agree, and they're going to do that. The question is, what's the reaction on prices? I think we're already seeing it, Tom, throughout this year. We've talked about this rolling correction. We've seen the weaker asset prices actually correct significantly around the world and even in the U.S., and that's the way the market's dealing with it. The big question is, will there then be a broader correction kind of at the, say, S&P 500 level? We think there will be. It's a correction to buy, but we think that, this is part of the mid-cycle transition. The Fed is moving away from maximum accommodation, just like they did in 94, just like they did in 04, and just like they did in 2011. It usually ends with some financial pullback in equities, and that's what we're expecting.
So, Mike, are you saying that, in other words, if Fed Chair Jay Powell comes out today and indicates a willingness to start tapering sooner or faster or something that gets people thinking that accommodation is being withdrawn sooner, that equities will sell off materially?
I mean, I think it's going to happen regardless, Lisa. I mean, this is inevitable. I mean, by the way, if we don't taper, that means something really bad has happened in the recovery. So it's a good thing that we're able to get to this point, okay? But financial markets have discounted not only the recovery, but also that rates are going to stay lower forever. And that's probably not a real possibility. You can't have that outcome where the economy is good and rates just stay lower forever. And the market's going to start to discount that regardless of when they begin. And let's say they do it earlier rather than they're going to do it. at some point in the next 3 to 4 months. That's basically the base case. That's what they've been guiding us to, and they've been preparing the markets for that. But ultimately, the markets will deal with it on its own terms.
So, Mike, which sectors do you think will lead the downdraft, given the fact that there have been some that have been more elevated, like big tech, and yet the cyclicals would be perhaps more affected by the slowdown in consumer spending that you talk of?
Yeah, so we've talked about already. We've seen a rolling correction this year. Lisa, I mean, the small caps have really underperformed significantly since March, as an example. Some of the early cycle sectors that tend to do best when the recovery is beginning have started to underperform, like transportation stocks, some of the retailers, even semiconductors. They've done well, but they've actually underperformed. And that's, autos. These are the classic type of areas that feel the pinch of liquidity first. So that's already happened. That's good. And I think what's going to happen next is you're now going to see it at the major average level. You're going to see it at the S&P level, which does mean probably some of these larger big cap growth companies probably get the multiple squeeze.
Michael Wilson with us from Morgan Stanley. We welcome all of you on radio and television. A lot to talk about, including the equity markets and all the guesstimates forward. We await Chairman Powell, not in 8 minutes, but maybe in 12 minutes. Michael McKee will give us those important critical headlines. I believe they're out at 10 o'clock, maybe 10:01. They're usually very precise about that. Please stay with us on radio and TV for McKee and the analysis of the Powell headlines, and then, of course, the importance of the Powell speech as well. Mike Wilson, I want to go back to Michigan. You were buried in a classroom as a young freshman, and you had to nail the linear math of the linear extrapolation. And then, Mike Wilson, there was the fear you had to take it to logs. Right now, we are living extrapolation. Many of your brethren are extrapolating out a better pathway for the Standard & Poor's 500. What's the trap of extrapolation?
Well, I mean, look, I think, the last year has been remarkable in so many ways. It's hard to count them. But the one thing that we're pretty certain about is that there was a period of overconsumption, okay? And, that there's going to be payback in a way that we don't think necessarily certain estimates or forecasts are reflecting. And that's what the risk of extrapolating what we think is a one-time bump that we're never going to see again, what we saw in the first half of this year. The fiscal stimulus was gargantuan, and it translated directly into consumption. And so we're just so far above trend, Tom, on everything that we look at that we have to go back to trend at some point. And so the danger of extrapolating a trend that's unsustainable is that you're disappointed at some point. And we think that'll happen over the next 6 months, and then we'll move, and then life will move on, and it'll be fine. But we think people are being pretty naive about the sustainability of some of the trends we saw in the first half.
Mike Wilson, I'm going to extrapolate out for all of surveillance, even Farrow, if he ever returns from wherever the hell he is. Mike Wilson, we extrapolate out. We want to speak to you soonest. Thank you so much with Morgan Stanley. He and his colleague Ellen Zentner are no doubt watching the speech, Lisa, here in the next couple minutes. Lisa, why did you bring in Gina Martin Adams, who's been listening to all of this?
Yeah, Gina Martin Adams, who's been looking at the potential for a taper tantrum, or at least a taper response, to have a greater effect on equities than possibly even the Delta variant. She joins us now, of chief economist for Bloomberg Intelligence. I'm just wondering, chief equity strategist, for Bloomberg Intelligence, what's your sense in terms of how we're gearing up equity-wise and what the expectation is baked in?
Yeah, I think that Mike Wilson is pretty close to in line with our views in that the market has been rotating in advance of taper, has been rotating in preparation for slightly tighter or maybe less easy, let's call it, Fed policy over the course of the next 6 to 12 months, but hasn't capitulated to the idea of a longer term tightening of policy. And I think that that's the key differential to keep in mind is a taper is not a tightening. A taper is just we're going to feed less into the punch bowl than we have in the past. And what we've seen over the last cycle is tapers have typically basically halted valuation expansion on the S&P 500, and prices merely rise at the pace of earnings growth. That, I think, is what you can expect over the near term. When the Fed starts to talk about tighter rates, they start to talk about the taper actually turning into a tightening, then you get greater pressure on the valuation multiple, and those periods of time are typically much more difficult for stocks. The only time we had that in the last cycle was in 2018. Thankfully, we had some offsetting support via tax policy to make up for the tightening that we were experiencing from the Fed, but we did see material valuation pressure emerge in that scenario.
Oh, wait.
Our view is that you likely see the market react to this in a more volatile fashion, but ultimately stocks rise. They just rise at a slower pace and a pace more in line with earnings growth.
Gina, there's so much in here to unpack. I mean, including this idea of separating out the taper from rate hikes, which, as Raphael Bostic of the Atlanta Fed was talking about earlier, he sees it as completely different items. If the Fed successfully does that and actually separates these two functions, could you see even a relatively rapid taper not having much of an impact at all on stocks?
You could, and as a matter of fact, we did see that in the last cycle where you had this relatively rapid taper, but you still had very supportive lower for longer interest rates for a period of time. The net effect was modest valuation pressure. At that time in 2011, I'm speaking of course, and then into 2014, you had the market really trade more in line with earnings growth. Valuations were still supported by the idea that a taper is still a net effect of positive expansion in the balance sheet, just not as positive. Earnings were really the predominant driver of the market. And earnings growth, I think, is the really big key to watch here, because earnings growth is slowing down. But is earnings growth going to topple over? Are we going to move into a contraction in earnings? Are we going to see a real squeeze on margins? Other factors beyond the Fed are likely to drive that. I think the one thing we're kind of missing in all this discussion is what's going to happen with fiscal policy here? Are we going to continue to see fiscal policy expand? That is a pretty significant potential driver of earnings growth. Or are we going to see tax rates increase? Tax hikes could be the factor that nobody's talking about that ultimately really dismantle the market's path to progress, because they're the predominant driver of potential earnings changes going forward.
Gina Martin Adams, thank you so much. Greatly appreciate it with Bloomberg Intelligence. The Dow up 96 points. Let me do a full data check here as we go into Chairman Powell's speech in a minute. And we'll have comments from Mike McKee on the headlines, which will move the market. The Dow up 95, SPX up 0.3%. The VIX in a stick off all of the horrific news out of Kabul yesterday. The VIX 17.64. Critically, yields have barely moved, but I do make note of a 133 handle on the 10-year yield, some curve flattening. Lisa Abramowicz noting that as well. Real yield does nothing, and the dollar I'm going out to 4 digits, folks.
It's that kind of day.
Lisa, I'm overselling this.
Yeah, look, honestly, there's not a lot going on in the market. I do think, though, the curve flattening is interesting because it's gained pace, and you can actually see the gap between 5-year and 30-year treasuries narrowing to the least in about a year. And this comes amid an increasing slew of Fed officials coming out in support of tapering sooner. And you do wonder what this message is in terms of curtailing future growth.
Now, there'll be many messages, but there'll also be many headlines. The tradition here, folks, is a Kansas City Fed in control of the message. And we're going to see that with the papers coming out in an orderly note. But also we're going to see it in terms of the headlines of the chairman. And the headlines are simple. We do have the breaking news here of a speech. Michael, please.
Well, if you are looking for a signal from Jay Powell, there will be discussions on Wall Street about whether he's giving one, but I'm going to come down in the camp of, yes, Powell is saying tapering is on the way. Here are the key quotes from his address, the prepared text for his remarks. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. He goes on to say, at the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July. Now, he goes on to say they'll be watching the data carefully, but it does seem to put him in the camp of those who are ready to start tapering. He doesn't give a direct signal, but that's a pretty strong lean in the direction of starting to cut back on QE. He does note that labor market conditions are improving but turbulent, and the pandemic continues to threaten not only health and life, but also economic activity. Earlier today, we got a higher PCE inflation rate. Powell continues to stick to the idea that it is going to be a transitory effect. He said because inflation at this point is not broad-based. It's a higher inflation. Items are moderating. Long-term inflation expectations are low, and globalization continues. All right. So now we will hear from him, the chairman himself.
Here is Chairman Powell.
The COVID-19 pandemic. This shock led to an immediate and unprecedented decline, as large parts of the economy were shuttered to contain the spread of the disease. The path of recovery has been a difficult one, and a good place to begin is by thanking those on the front line fighting the pandemic. The essential workers who kept the economy going, those who have cared for others in need, and those in medical research, business, and government who came together to discover, produce, and widely distribute effective vaccines in record time. We should also keep in our thoughts those who have lost their lives from COVID, as well as their loved ones. Strong policy support has fueled a vigorous but uneven recovery, one that is, in many respects, historically anomalous. In a reversal of typical patterns in a downturn, aggregate personal income rose rather than fell, and households massively shifted their spending from services to manufactured goods. Booming demand for goods and the strength and speed of the reopening have led to shortages and bottlenecks, leaving the COVID-constrained supply side unable to keep up. The result has been elevated inflation in durable goods, a sector that has experienced an annual inflation rate well below zero over the past quarter century. Labor market conditions are improving but turbulent, and the pandemic continues to threaten not only health and life, but also economic activity. Many other advanced economies are experiencing similarly unusual conditions. In my comments today, I will focus on the Fed's efforts to promote our maximum employment and price stability goals amid this upheaval, and suggest how lessons from history and a careful focus on incoming data and the evolving risks offer useful guidance for today's unique monetary policy challenges. The pandemic recession, the briefest yet deepest on record, displaced roughly 30 million workers in the space of 2 months. The decline in output in the second quarter of 2020 was twice the full decline during the Great Recession. But the pace of the recovery has exceeded expectations, with output surpassing its previous peak after only 4 quarters, less than half the time required following the Great Recession. As is typically the case, the recovery in employment has lagged that in output. Nonetheless, employment gains have also come faster than expected. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. The unevenness of the recovery can further be seen through the lens of the sectoral shift of spending into goods, particularly durable goods such as appliances, furniture, and cars, and away from services, particularly in-person services in areas such as travel and leisure. As the pandemic struck, restaurant meals fell 45%, air travel 95%, and dentist visits 65%. Even today, with overall GDP and consumption spending more than fully recovered, services spending remains about 7% below trend. Total employment is now 6 million below its February 2020 level, and 5 million of that shortfall is in the still depressed service sector. In contrast, spending on durable goods has boomed since the start of the recovery and is now running about 20% above the pre-pandemic level. With demand outstripping pandemic-afflicted supply, rising durables prices are a principal factor lifting inflation well above our 2% objective. Given the ongoing upheaval in the economy, some strains and surprises are inevitable. the job of monetary policy is to promote maximum employment and price stability as the economy works through this challenging period. I'll turn now to a discussion of progress toward those goals. The outlook for the labor market has brightened considerably in recent months. After faltering last winter, job gains have risen steadily over the course of this year and now average 832,000 over the past 3 months, of which almost 800,000 have been in services. The pace of total hiring is faster than at any time in the recorded data before the pandemic. The levels of job openings and quits are at record highs, and employers report that they cannot fill jobs fast enough to meet returning demand. These favorable conditions for job seekers should help the economy cover the considerable remaining ground to reach maximum employment. The unemployment rate has declined to 5.4%, a post-pandemic low, but is still much too high, and the reported rate understates the amount of labor market slack. Long-term unemployment remains elevated, and the recovery in labor force participation has lagged well behind the rest of the labor market, as it has in past recoveries. With vaccinations rising, schools reopening, and enhanced unemployment benefits ending, some factors that may be holding back job seekers are likely fading. While the Delta variant presents a near-term risk, the prospects are good for continued progress toward maximum employment. The rapid reopening of the economy has brought a sharp run-up in inflation. Over the 12 months through July, measures of headline and core PCE inflation have run at 4.2% and 3.6% respectively, well above our 2% longer run objective. Businesses and consumers widely report upward pressure on prices and wages. Inflation at these levels is, of course, a cause for concern. But that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary. This assessment is a critical and ongoing one, and we are carefully monitoring incoming data. The dynamics of inflation are complex, and we assess the inflation outlook from a number of different perspectives, as I will now discuss. The spike in inflation is so far largely the product of a relatively narrow group of goods and services that have been directly affected by the pandemic and the reopening of the economy. Durable goods alone contributed about 1% to the latest 12-month measures of headline and core inflation. Energy prices, which rebounded with the strong recovery, added another 0.8% to headline inflation. And from long experience, we expect the inflation effects of these increases to be transitory. In addition, some prices, for example, for hotel rooms and airplane tickets, declined sharply during the recession and have now moved back up close to pre-pandemic levels. The 12-month window we use in computing inflation now captures the rebound in prices, but not the initial decline, temporarily elevating reported inflation. These effects, which are adding a few tenths to measured inflation, should wash out over time. We consult a range of measures meant to capture whether price increases for particular items are spilling over into broad-based inflation. These include trimmed mean measures and measures excluding durables and computed from just before the pandemic. These measures generally show inflation at or close to our 2% longer run objective. We would be concerned at signs that inflationary pressures were spreading more broadly through the economy. We are also directly monitoring the prices of particular goods and services most affected by the pandemic and the reopening, and are beginning to see a moderation in some cases as shortages ease. Used car prices, for example, appear to have stabilized. Indeed, some price indicators are beginning to fall. If that continues, as many analysts predict, then used car prices will soon be pulling measured inflation down, as they did for much of the past decade. This same dynamic of upward inflation pressure dissipating and in some cases reversing seems likely to play out in durables more generally. Over the 25 years preceding the pandemic, durables prices actually declined, with inflation averaging negative 1.9% per year. As supply problems have begun to resolve, inflation in durable goods other than autos has now slowed and may be starting to fall. It seems unlikely that durables inflation will continue to contribute importantly over time to overall inflation. We will be looking for evidence that supports or undercuts that expectation. We also assess whether wage increases are consistent with our 2% inflation goal over time. Wage increases are essential to support a rising standard of living and are generally, of course, a welcome development. But if wage increases were to move materially and persistently above the levels of productivity gains and inflation, businesses would likely pass those increases on to customers, a process that could become the sort of wage price spiral seen at times in the past. Today, we see little evidence of wage increases that might threaten excessive inflation. Broad-based measures of wages that adjust for compositional changes in the labor force, such as the Employment Cost Index and the Atlanta Wage Growth Tracker, show wages moving up at a pace that appears consistent with our longer-term inflation objective. We will continue to monitor this carefully. Policymakers and analysts generally believe that as long as longer-term inflation expectations remain anchored, policy can and should look through temporary swings in inflation. Our monetary policy framework emphasizes that anchoring longer-term expectations at 2% is important for both maximum employment and price stability. We carefully monitor a wide range of indicators of longer-term inflation expectations. These measures today are at levels broadly consistent with our 2% objective. Because measures of inflation expectations are individually noisy, we also focus on common patterns across the measures. One approach to summarizing these patterns is the board staff's Index of Common Inflation Expectations, which combines information from a broad range of survey and market-based measures. This index captures a general move down in expectations starting around 2014, a time when inflation was running persistently below 2%. More recently, the index shows a welcome reversal of that decline and is now at levels more consistent with our 2% objective. Longer-term inflation expectations have moved much less than actual inflation or near-term expectations, suggesting that households, businesses, and market participants also believe that current high inflation readings are likely to prove transitory and that in any case, the Fed will keep inflation close to our 2% objective over time. Finally, it is worth noting that since the 1990s, inflation in many advanced economies has run somewhat below 2%, even in good times. The pattern of low inflation likely reflects sustained disinflationary forces, including technology, globalization, and perhaps demographic factors, as well as a stronger and more successful commitment by central banks to maintain price stability. In the United States, unemployment ran below 4% for about 2 years before the pandemic, while inflation ran at or below 2%. Wages did move up across the income spectrum, a welcome development, but not by enough to lift price inflation consistently to 2%. While the underlying global disinflationary factors are likely to evolve over time, there is little reason to think that they have suddenly reversed or abated. It seems more likely that they will continue to weigh on inflation as the pandemic passes into history. We will continue to monitor incoming inflation data against each of these assessments. To sum up, the baseline outlook is for continued progress toward maximum employment, with inflation returning to levels consistent with our goal of inflation averaging 2% over time. Let me now turn to how the baseline outlook and the associated risks and uncertainties figure in our monetary policy making. The period from 1950 through the early 1980s provides two important lessons for managing the risks and uncertainties we face today. The early days of stabilization policy in the 1950s taught monetary policymakers not to attempt to offset what are likely to be temporary fluctuations in inflation. Indeed, responding may do more harm than good, particularly in an era where policy rates are much closer to the effective lower bound even in good times. The main influence of monetary policy on inflation can come after a lag of a year or more. If a central bank tightens policy in response to factors that turn out to be temporary, the main policy effects are likely to arrive after the need has passed. The ill-timed policy move unnecessarily slows hiring and other economic activity and pushes inflation lower than desired. Today, with substantial slack remaining in the labor market and the pandemic continuing, such a mistake could be particularly harmful. We know that extended periods of unemployment can mean lasting harm to workers and to the productive capacity of the economy. History also teaches, however, that central banks cannot take for granted that inflation due to transitory factors will fade. The 1970s saw two periods in which there were large increases in energy and food prices, raising headline inflation for a time. But when the direct effects on headline inflation eased, core inflation continued to run persistently higher than before. One likely contributing factor was that the public had come to generally expect higher inflation. One reason why we now monitor inflation expectations so carefully. Central banks have always faced the problem of distinguishing transitory inflation spikes from more troublesome developments, and it is sometimes difficult to do so with confidence in real time. At such times, there is no substitute for a careful focus on incoming data and evolving risks. If sustained higher inflation were to become a serious concern, the FOMC would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. Incoming data should provide more evidence that some of the supply-demand imbalances are improving, and more evidence of a continued moderation in inflation, particularly in goods and service prices that have been most affected by the pandemic. We also expect to see continued strong job creation, and we'll be learning more about the Delta variant's effects. For now, I believe that policy is well positioned. As always, we are prepared to adjust policy as appropriate to achieve our goals. That brings me to a concluding word on the path ahead for monetary policy. The committee remains steadfast in our oft-expressed commitment to support the economy for as long as is needed to achieve a full recovery. The changes we made last year to our monetary policy framework are well suited to address today's challenges. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis. These are challenging times for the public we serve. as the pandemic and its unprecedented toll on health and economic activity linger. But I will end on a positive note. Before the pandemic, we all saw the extraordinary benefits that a strong labor market can deliver to our society. Despite today's challenges, the economy is on a path to just such a labor market, with high levels of employment and participation, broadly shared wage gains, and inflation running close to our price stability goal. Thank you very much.
You've been listening to Fed Chair Jay Powell speaking at this year's virtual Jackson Hole Summit. The notes that I'm getting from strategists so far is that this is a dovish taper. It feels like a taper. September is definitely off the table, but a very clear signal from Jay Powell that he will endorse tapering by the end of the year. Welcome to Bloomberg Markets from New York. I'm Alex Steele with my co-host for today, Francine Lacqua. Guy Johnson is off. And Francine, you're seeing that in the market, sort of a reaction, equities rallying, dollar down, but nothing massively significant in terms of asset prices.
No, it was actually a pretty cautious speech, and I know we'll speak to our Michael McKee very shortly. I mean, he basically, the Fed chair saying that it could be appropriate to begin tapering this year. What was also interesting is actually the assumption about, the hiking rates right after the tapering decision. This is probably one of the most interesting in terms of sequencing, and maybe that's what the markets will take in their stride, that you can start tapering if it's not September, October, maybe November, but it's unclear whether a rate hike could then come before they stop tapering.
But after that move in yields over the last few days, we're definitely seeing some softness, yields coming lower as some little buying coming in the back end. Let's get some more detail here. Michael McKee, Bloomberg International economics and policy correspondent, joins us now. Mike, your biggest takeaway?
I think that the chairman is ready. He's joined the rest of the group, and they will announce tapering soon. Whether they do it in September or not would probably depend in large measure on the jobs report a week from today for August, and also the progress of COVID. They'll be keeping a very close eye on that. If there are signs that it has peaked and the job market is good, we get in the middle of the month the CPI report. The Fed may have enough information to at least say tapering is coming in September, which would start the repricing process. And it does seem like everybody is pretty much on board now that there isn't much need for this emergency measure anymore.
But Mike, at the same time, he was, very dovish when it comes to inflation. He reiterated that inflation was going to be transitory, and he didn't talk much about the Delta variant.
Yeah, they don't really have a good handle on how it's going to affect inflation going forward, because this time we are not seeing shutdowns the way we saw. We will see additional supply chain problems, but those are on the supply side, and the Fed affects the demand side, so there isn't much they can do about that. Their problem would be if people stayed home and stopped going out and spending money, and they really don't know yet whether that's going to happen. Early indications are there's a little bit of a fall off, but not that much. So at this point, Powell is keeping an eye on it, shall we say. But and to that extent, it drives policy. If things get bad, they'll wait. But if not, they go forward.
Mike, were you surprised at how little we heard about Delta?
No, he's not a doctor.
Well, sure, but he did talk about it, activity or softness.
He did. Well, that's because, as I say, they don't have a lot of data. They don't have a lot of information on this yet. And he said, it is still a risk. And we are keeping an eye on that, and we will start tapering depending on the progress of the disease. So at this point, I think the Fed is, like everyone else, kind of wondering what's going to happen, but figuring, based on past history, that we'll get past it, and then there will be time to start moving.
All right, Mike, thank you so much. Bloomberg's Michael McKee there with the very latest on Jay Powell. Coming up later today, Mike will also be speaking to the Cleveland Fed President, Loretta Mester. That's at 1 p.m. in New York, 6 p.m. in London.